Market conditions continued to be pretty unstable in September following the brutal sell-off that took place in August. The MSCI World was down 4% in September following the 7% drawdown in August, which represents a 10% cumulated loss for global equities over the last 2 months. We understand that such market uncertainties were related to China's currency devaluation and renewed deflation fears across the globe. Overall, hedge funds were not totally immune to such adverse market conditions, but still managed to outperform traditional asset classes. The Lyxor hedge fund index was down 1% in September, which is an outperformance compared to risk assets in general, and in particular, Europe suffered stronger sell-off than US equities. Across hedge fund strategies, we had a significant divergence with CTAs outperforming other hedge fund strategies and event-driven managers underperforming in this volatile market environment. Overall, this is in line with our expectations. We've been overweight CTAs and neutral event-driven managers to the extent that we somewhat anticipated that the summer would be shaky ahead of the Federal Reserve meeting mid-September, which eventually decided not to hike rates. In between, long-short equity managers and global macro players delivered flat returns in September, which is still an outperformance compared to traditional asset classes. In particular, European managers were quite resilient in front of the equity market sell-off, while Asian managers suffered somewhat more than other strategies. Long-short equity managers reduced significantly their risk appetite. In particular, the leverage of Asian long-short managers was significantly reduced, and US managers also reduced significantly their leverage. Going forward, we think that markets have been somewhat too pessimistic. We think that a rebound in risk assets is due to take place in October. And in regard to this expectation, we turned overweight event-driven managers. We think that a rebound is due for this strategy, while at the same time we continue to be overweight CTAs. We think that this strategy is a very attractive diversifier in portfolios and an attractive diversification strategy against deflation risks that continue to weigh on the global economy. On the long-short equity space, we have a preference for market-neutral managers compared to long-biased long-short equity players. Market-neutral managers really have attractive diversification benefits in the portfolio, and they have been quite resilient during the recent market turmoil. Finally, we continue to be overweight as well global macro managers. We think that they provide protection against downturns, and at the same time they have the ability to capture any rebound that we expect will take place over the coming weeks.